You bought your first home in 2021, maybe 2022. The government told you it was the right time. Interest rates were at 0.1%, the lowest in the Bank of England's 330-year history. The 95% mortgage guarantee scheme meant you only needed a 5% deposit. Help to Buy covered the rest. Stamp duty was cut. The message from every institution in the country was the same: get on the ladder. So you did. You stretched for the deposit. You signed the fix. You moved in. And then the Bank of England raised interest rates 14 times in 20 months. House prices fell across 80% of the country, and you woke up owing more than your home is worth. There are now 463,000 homeowners in that position across the United Kingdom. Here is the thing. This was not a market correction. This was a trap. And the people who set it are not the ones paying for it. Start with what happened in 2021. The base rate sat at 0.1%. Mortgage lenders were offering 2-year fixes below 2%. The government launched the 95% mortgage guarantee scheme in April, explicitly encouraging first-time buyers to enter the market with a 5% deposit. Help to Buy had already been inflating new build prices for years, and developers knew the government was subsidizing purchases, so they raised prices to absorb the subsidy. Independent analysis consistently showed new build premiums of 10 to 20% above equivalent second-hand homes. Meanwhile, house prices were climbing at nearly 10% a year. By March 2022, the average UK home cost £278,000, £24,000 more than a year earlier. The government guaranteed the loans. The banks issued the rates. The regulators approved the products. The prices climbed. And nobody in any position of authority said, "Stop." Think about that. The same institutions that would later raise rates fast enough to crash the market were, at this point, actively encouraging people to borrow at the peak. Then the rates moved. In December 2021, the base rate was 0.1%. By August 2023, it was 5.25%. That is not a gradual adjustment. That is the fastest tightening cycle in modern Bank of England history. The average 2-year fixed mortgage rate on the 26th of July 2021 was 2.52%. 2 years later, on the 26th of July 2023, it was 6.86%. For someone with a £500,000 mortgage, rolling off a pandemic-era fix onto a current rate means an extra £833 a month. That is £10,000 a year in additional payments, for the same house, the same job, the same salary. And if you did nothing, if you let your fix expire without remortgaging, your lender moved you onto their standard variable rate. Those sit between 7% and 9%. Martin Lewis called it a mortgage ticking time bomb. 350,000 5-year fixes are due to expire between October 2025 and February 2026 alone. Every one of them was taken out when rates were below 2%. Here is where it gets alarming. The people who followed the advice, who bought when rates were low, who stretched for the deposit, who did what the system told them to do, are the ones now paying the price. Not the banks, not the regulators, not the politicians who stood in front of cameras and said this was the path to security. You. Think about what negative equity actually means. You owe more than your home is worth. You cannot sell without covering the shortfall from savings. You cannot remortgage because no mainstream lender will offer a deal above 100% loan to value. You cannot move because you would have to pay to leave your current home and pay again to arrive at the next one. Stamp duty, solicitors, surveys, removals. You are financially cemented into a property that is worth less than the debt attached to it. If you bought with a 95% mortgage, house prices only needed to fall 6% to push you underwater. In 2023, London prices fell 4.8%. The Northeast fell 6%. Prices dropped across 80% of the country. 463,000 homeowners are now in negative equity. 8% of all mortgage holders. In Northern Ireland, that figure is 41%. 68,000 households in a single region, trapped. Northern Ireland still has not fully recovered from the 2008 crash. Some properties bought at the peak are still worth half of what their owners paid, and now a second wave has arrived before the first one receded. And then there are the mortgage prisoners. The Financial Conduct Authority estimates 195,000 borrowers are stuck with inactive lenders, firms that no longer issue new mortgages. These people cannot switch, cannot negotiate, and are paying standard variable rates of 8 to 9%, while the rest of the market has moved on. The FCA introduced rule changes in 2021 to help them. Those changes resulted in approximately 200 switches. 200 out of 195,000. That is not a policy. That is not even a gesture. That is a rounding error dressed up as reform. You are not stuck because you made a bad decision. You are stuck because every institution that was supposed to protect you made the decision for you and then walked away. In the early 1990s, interest rates hit 15%. Over 1.3 million households fell into negative equity. 75,000 homes were repossessed in 1991 alone. The cause was identical. Financial deregulation in the 1980s made credit easy, prices inflated, rates rose sharply, and ordinary buyers were left holding the loss. The recovery took the rest of the decade. What happened after? No structural reform, no caps on loan-to-value ratios during price booms, no requirement for stress testing at realistic rate levels. Instead, the government launched Help to Buy, guaranteed 95% mortgages, and cut stamp duty to accelerate purchases during a price bubble. The 1990s should have been the lesson. Instead, it became the blueprint. In France, a fixed-rate mortgage means fixed for 15 to 25 years, the full term of the loan. In the UK, a fixed rate means 2 to 5 years. After that, you renegotiate at whatever the market gives you. The UK is no longer bound by the EU Mortgage Credit Directive. There is no external standard holding lenders or regulators to account. The word fixed is doing a lot of work in British mortgage marketing. It should not be. A French homeowner who locked in at 2% in 2021 is still paying 2% today. A British homeowner who did the same is now paying 5%. That is not a difference in markets. That is a difference in protections. Here is what this looks like in practice. A couple bought in 2022 for £278,000 with a 5% deposit, £13,900 saved over years. Their mortgage was £264,100 on a 2-year fix at 2.5%. Their monthly payment was roughly £1,100. That fix ended in 2024. The best rate they could find was 4.9%. Their monthly payment jumped to approximately £1,550, an extra £450 a month they did not budget for because no one told them. Their home is now worth roughly £270,000 if they are fortunate. After 4 years of mortgage payments, their equity is less than £6,000, less than they put down. If they need to sell, estate agent fees, solicitor costs, and stamp duty on a new purchase would wipe out what little equity remains and leave them with a shortfall. They followed every piece of advice the system offered. They are worse off than when they started. 4 years of mortgage payments and they have gone backwards. Every policy that made it easier to buy made it harder to leave. If that sounds like a design flaw, consider the possibility that it is not a flaw at all. If you are watching this and you are in this situation, know that you are not alone. You are not at fault, and the conversation about who is responsible has barely started. Subscribe if you want to be here when it does.